Myself, Angkita Sarma from Department of Finance. So in today's session, we'll discuss about mutual funds. So the first topic is, what do you mean by mutual fund, or what is the meaning or the concept of mutual fund? So we know that a mutual fund is a common pool of money into which the investors place their investment into a contribution that are to be invested or reinvested in different kinds of government or be the corporate securities. A mutual fund can be both equity fund or bond fund. If it is an equity fund, then it would definitely buy the equity shares, preference shares, or the warrants, etc. And if it is a bond fund, then it would buy the debentures, bonds, or any other government securities. In easier term or in simple term, if we want to understand what actually mutual fund is, that it is a financial intermediary that pools the mobilization of savings, or that mobilize the savings of the investors and then reinvest it in different types of corporate or the government securities. It is a cyclic process in which the investors pool their money with the fund manager. Every mutual fund has a professional fund manager, and they again invest it in the securities with the risk taking securities or with a low risk securities, and then generates some kinds of returns from the securities. The returns is in the form of interest or dividend besides the capital gains. And then that kind of returns will again be passed or passed back to the investors. So our next topic is the features of mutual fund. Number one, mutual fund is a multi-tier institution. The multi-tier means there are three types of players, or the three parties involved in a mutual fund. Number one are the sponsors, who have to take the permission from the SEBI to establish that mutual fund, but a sponsor couldn't work alone as a mutual fund. So they will have to create a trust under the Indian Trust Act, and then they will have to register it with SEBI, and that trustee will get automatically registered with SEBI. So the amongst the three players, the first one will be the sponsors, the second will be the trustees, and the third will be the AMCs, that is the asset management companies. The AMCs are basically formed under the Indian Companies Act, and they are registered with SEBI. So number two is flexible investment. In case of mutual fund, the investment that the investor used to get engaged with, that has a flexibility. That means there is no limitations regarding the units, there is no limitations regarding the time period. Therefore, it has the flexibility to invest in any time and in any terms of amount. It can be for short term, it can be for long term also. So number three is simple investment procedure. Mutual fund investment is considered as a simple investment procedure. The investment procedure with the help of KYC documentation is considered as a simple and an easy one. However, the new method of eKYC along with the documentation of other is also considered as the simplest and the easiest one. Next is transparency in investment. In case of mutual fund, we can see the transparency. That is, the AMCs will have to produce a kind of fact sheet in a monthly basis. The fact sheet is a documentation in which all kinds of performance of the fund manager or all kinds of funds regarding the mutual fund investment is being documented in that documentation, that is in the fact sheet. Next is multiple investment choices. As we can see, different types of mutual funds are available. That is the debt fund or equity fund. We have the liquid funds. We have low risk fund or high risk fund. On the basis of various dynamic market rates, the investor have multiple investment choices in case of mutual funds. Next is no fixed return. The returns that we get in terms of interest or dividends besides the capital gains is not a fixed amount. It can be, sometimes it can be a high amount, we get a high return, and sometimes it can be a low return also. Next is a diversified investment. In case of mutual fund, the investment is expanded in a large area. That means we can invest in various types of mutual fund at the same time in a diversified way. Next is professionally managed. All kinds of mutual funds are managed by a professionally designated fund manager along with the knowledge, and they are selected by the research and the analyst of the mutual funds. Next is investment and the withdrawal option. In case of mutual fund, we have various kinds of investment option. That is, people can invest in one time also, or it can be invested in SIPs also. SIP is systematic investment plan, that is in a monthly or in a half yearly or quarterly also. A mutual fund schemes can be invested, and the withdrawal options are also there. That is, systematic withdrawal plans are also there. We can withdraw the amount on a fixed or in a certain period of time. Next is the tax benefit. In case of mutual fund, some of the schemes of mutual fund gives the tax benefits to the investors under the section 80C of the Indian Income Tax Act. So most of the investors gets the benefits of deduction of taxes from the mutual funds also. Our next topic is the advantages of mutual fund. Number 1, investment opportunity for the small investors. Now, why this been said as the small investors? Because in case of the large investors, the investors does not depend on the mutual funds, right? So therefore, the small investors who have a small amount of money as their savings and they want to invest it in mutual fund, then those investors are they are dependent on the mutual fund. Therefore, it's an opportunity for the small investors that they can invest their small amount of money in mutual fund and expect some kinds of returns from it. Next is diversification. The advantages of mutual fund is we will not stick to one mutual fund in one time. We will diversify our savings in various types of mutual fund schemes at the same time. Whatever may be the return, some may give high return or some may give low return, but we will invest it in a diversified way, in an expanded way. Next is convenience. The people who don't have much time to give, to take the study, to take the research in the funds or in the stock markets, they are basically dependent on mutual fund. Therefore, it is convenient for those people who don't have much time to give in the research of stock market. They will obviously get convenient with the working or the functions of mutual funds. Next is liquidity. It's an advantageous because financial the problems of finance or the financial problem is always uncertain for the people. Therefore, in case of liquidity also, it helps that in any time we can make our money invested, we can make our money withdrawal from the mutual funds. Then it's a simple procedure, as we have discussed it, that the documentation of KYC and the new rule of eKYC along with the documentation of other has become has got the process of mutual fund an easier and the simplest one. Next is low cost investment. In case of investment in mutual fund, the cost, that is the administrative cost or it can be the management cost, it is very low because thousands of people or the thousands of investors used to invest in mutual funds. Therefore, they collect the very minimum fees from the investors. It's very low. Next is transparency. As we told that every AMCs will have to deliver a fact sheet in a monthly basis, in which all kinds of facts regarding the investment of funds or regarding the performance of the fund manager will be there. So our next advantages of mutual fund is professionally managed. That is, the mutual funds are managed by the designated professional manager who has been selected by the researchers and the analysts, and the decision that a manager or the fund manager gives, that decision is accepted by the investors. Next topic is the disadvantages of mutual funds. Number one is, the most critical one is diversification. As we have studied, or we know that diversification is one of the most advantages of mutual fund, but over diversification will be the disadvantages for the mutual funds, because when you will diversify your portfolio in a vast number, then obviously it will reduce both the risks and the return also. Therefore, these kinds of over diversification will automatically become disadvantages for the investors. Next is no control over the portfolio. As we know that mutual funds are managed by the fund manager, therefore the investment will not get any kind of role in studying the portfolio. Therefore, there will be no control by the investors over the portfolio in case of mutual funds. Next is no insurance. A mutual fund scheme does not help in any kind of losses against insurance. Our next disadvantages is the fees and the expenses. Now, there are some kinds of mutual fund which charges a fees or a commission against the investment. So those kinds of mutual funds will give disadvantages for the investors to so that they will have to pay a large amount as a fees or the commission. Next is fluctuating returns. As we don't get a fixed return in case of mutual fund, we cannot predict it. Therefore, sometimes it can be high or sometimes it can be low. We cannot predict the returns in beforehand. Our next limitation is the trading limitations. So in case of some mutual funds, what happens, or you can take the example of open-ended mutual fund. In case of open-ended mutual funds, what happens, the investors cannot invest in the middle of the day. It will invest only at the end of the day. Therefore, it will get these kinds of trading limitations in some of the mutual funds. Next is size. Some mutual funds used to get the high units, or the amount of the units is very high, and some units will be very low. Therefore, the medium investors or the small investors will not be able to invest their amount in high units of mutual funds. So our next topic is the types of mutual fund. Mutual funds are classified on the basis of four. That is, number one, on the basis of asset class, number two, on the basis of structure, number three, on the basis of investment goals, and number four, on the basis of risks. On the basis of asset class, mutual funds are divided into four types. Number one is equity funds. Equity funds are the funds that is invested in stocks. The main objective of the equity fund is the long-term capital gain. Number two is debt fund. Debt fund are those funds in which 65% of the investment is in the bonds, debentures, or government securities. Next is money market funds. Now, as you know, the money market is a market for the small period of time, that is less than 1 year. Therefore, the money market mutual funds are the funds that is invested for safer short-term investment. That is the commercial bills or CDs, treasury bills we can say. Therefore, these are the money market mutual funds. Next is hybrid funds. Hybrid funds are the combination of both bonds and stocks. These funds mainly aims to eliminate the disadvantages of both the stocks and bond funds. The next is based on structure. On the basis of structure, mutual funds are divided into three types. That is open-ended mutual funds, closed-ended mutual funds, and interval funds. Open-ended mutual funds are those funds in which the investment opportunity is open for all. That is, the time period or the size of the units is open. That is not determined beforehand. Whereas the second one, closed-ended mutual fund, is just the opposite of the first. That is, the corpus of the size, the size of the corpus is predetermined. A company cannot sell more if that much of unit has not been agreed beforehand. And the third is interval funds. Interval funds are the combination of both open-ended and close-ended. That is, these funds deals with both the open-ended mutual funds and the close-ended mutual funds. The next is based on investment goals. On the basis of investment goals, mutual funds are classified into 4: growth fund, income fund, liquid fund, and tax saving funds. Growth funds are those funds which aims to get the capital appreciation by investing in the stocks which is in a growing nature, that is the growing stocks. Next is income funds. These funds basically aims to give a regular income to the investors. The investor will get a regular income, let it be daily, monthly or quarterly, but they will get a regular income. Next is liquid funds. Liquid funds basically tries to give the opportunity of liquidity to the investors. And the last one is tax saving funds. These funds aims to save the investor or help the investors regarding the tax. That is under section 80C of the Indian Income Tax Act. Last is based on risks. On the basis of the dynamic of risks or on the basis of the level of risks, these types of mutual funds are divided into 4 types. That is very low risk fund, medium risk fund, and a high risk fund. The investor whichever they will prefer, they will go with that type of risk. As you know, if the risks will be lower, the return will be lower, and if the risks will be higher, the return will also be higher. So apart from these types of classification of mutual fund, last we can say that there are again 2 types of classification of mutual fund. That is load fund and no load fund. Load fund means those mutual funds which charge a fees or the commissions to the investors on the part of investment, whereas no load fund is if there is no charge or no fees or no commission, then it is said as no load fund. Now again, load fund has been divided into 3, that is entry load, exit load, and level load. Entry load is if the investors will have to pay the fees or the commission at the time of entry to the investment, then it is known as entry load fund. If the investors will have to pay the fees or the commission at the time of at the ending time of the investment, then it is known as the exit load fund. And if the investors will have to pay the money or have to pay the fees or the commission the whole time of the investment, during the whole time of the investment or during the whole period of investment, then it is known as level load fund. And the no load funds means those funds which will not have any kind of charge or fees or commission, they will be considered as no load funds. Thank you.